Okay, good afternoon, everybody. Good evening, almost in the East Coast. And I'm Jim, the option professor. Quick background on myself. I went to Boston College and I've been in the options business for decades and decades. So I have done seminars throughout the country and actually worldwide. And I've educated thousands and thousands of people on the uses and risks of options. I've traded thousands and thousands of contracts of options. So I knew the product pretty good. I'm going to share with you my ideas and my references today. We also have an options alert service, which I will be explaining at the end of the broadcast. And I guess I'll start out with, as you guys, we're going to do analyze your trade. So if you have any trades you want me to analyze, please put them in the chat box and I will get to them as we get them in there. So if you have any stocks you're either looking at, are in right now, would like to find out my opinion on what's going on, please put it in that inbox. I'll take care of it for you. As far as today, I will be sharing my opinions and my observations. I will not be giving out any advice as far as that kind of thing. You always talk to your brokerage firm and you go through with them your suitability and risk tolerance. Make sure any type of trading is suitable for you. And of course, they will give you all the ideas and how to trade, how to place trades and all that kind of stuff. That's all done with your broker. I'm just strictly giving you opinions and observations here today. Okay. All right. So again, put your stocks in there and let me give you a quick overview of what's going on because it's a very exciting time. First of all, as I said in my alerts, and they come out every Sunday night, I told people that it seems to me there are two reasons why we have been going up and up and up now since 2023 October, right? That's pretty much when it started to move the most. It was October 12th of 2022 that it actually bottomed at around 3,500 on the S&P, but it really started taking off from October of 23. And again, a couple of things have really been going on since then. One is deficits, fiscal deficits. I mean, they're really a joke. In fact, a guy on CNBC was saying that since September 26th, a month ago, the deficit has gone up 500 billion. That is a very big jump in the deficit. And so when you are stimulating like that, fiscal stimulus, fiscal deficits, you're normally coming out of a recession. And so they're doing all this at the all-time high, which is kind of spooky. And also you've got Powell freaking out that the unemployment rate's at 4%. The average unemployment rate since like 48 is like 5.5%. So this guy's going nuts that it's at 4%. He must be nervous about something called consumer spending. And the other thing is the M2 money supply. So you got fiscal deficits going through the roof at a time where we're at the all-time high, which is normally a recession type thing coming out of recession. And now you got the M2 money supply, which was down 4.5%. It was minus 4.5% in 2023. And magically, it's now up almost to 2.6, and it's above the inflation rate. So obviously they're printing money and they're borrowing money to keep this thing going. And that's why the liquidity is on steroids. And that's why the prices are on steroids as well. So there's a good little insight that you might not have been thinking about as far as those two factors, which are very important. Now let's talk about another factor here that's very important is the yield on the 10-year treasury. Okay, let's go take a look. So the yield on the 10-year treasury has been rising even after they just cut 50 basis points. Hey, 50 basis points is a huge cut. And then we were at 3.6% or so on the 10-year. And now we're going to see where it is today. And we're going to see it's at a lot higher than 3.6, like 4.27. And I think today it even hit a high point of what? What's the high today? 434. So again, I and this gentleman, Stanley Druckenmiller, were thinking that the yields would rise from the 360 level. He has his own methodology. My methodology is this chart right here. You see, when it comes down to the blue line, that's called a trend line and a moving average. And it's a pretty darn good moving average because it doesn't bend very much because it's longer term. So when it came down to this number, I was saying everybody's buying bonds. They should be selling bonds. Why? Because it's coming into a support area on yield, which means it's coming into a top on the bond market. And obviously people who sold bonds against that number are making money because as the rate jumps, the bonds decline in price. So that's how I was reading it, and that's the way I'm reading it still. So if we were to jump up above 450 and 5%, do you think the stock market's ready for that? I would say no. So we'll keep an eye on the 10-year note. The second thing I'm trying to show you here is I'm trying to show you what the VIX is doing. Why is that? Well, because I'm the option professor, right? I'm supposed to be watching the VIX. So anyway, here we go. I go back to 20-year graph, and what do I get? I get something that looks, every time you're near a low, the RSI here is on the 40 level, right? 40, 43. Then you got lows down here, 46. You got lows down here, 50, 46. You got lows down here, 47, 44, 49, 43. So it's coming out of a zone that generally is a low on the VIX, right? Now, again, you don't have it where it's that dangerous like it is here. See, it gets very dangerous here because you got the red line above the gold line, and that's when the VIX can be very, very volatile, and that's during COVID, right? Right. And then, of course, it was kind of here, but it didn't really get going above there. But this was like that 25% drop in the fourth quarter of 2018. So right now, where are we? We are at 934, right? And look where the moving averages are. They're all at 14, 16, right? 18. So you're above a lot of the moving averages. If we were to get back above 20, 21, I think there's a chance it's going to spike. So I'm watching it. I'm watching like a hawk. Why? Because look, here's where your line is right there, 17, 1770, 1790. If it got under there, then I would say green lights and blue skies for the stock market. If we get above the yellow line here and start closing above 2136, I think it's going to open the door for a spike up in the VIX. And if the VIX spikes up, I think we all know where the stock prices are going. So would I watch this? I sure would. And would I jump the gun on it? Not really, but I'd be watching it because, again, let's look at the SPX and I'll show you what I'm talking about there. Again, remembering that the fiscal deficits and the printing of the M2 is really fueling this thing. So after the election, whatever's going on now to get whoever going, that reasoning is off the table because once they got the job, they don't need your votes anymore, right? Right. So the bottom line is that's why things can change. And so basically, if they do change, meaning the fiscal spending craze actually doesn't keep going up, but actually comes off, or the money supply growth starts shrinking or stabilizing, then this stuff may have a problem continuing up. Now, like I say, this is what I see. These are my long-term averages, 5,200 ballpark area, right? 5,256, right? Or all the way down to, well, are you here? Now let's see where we are. Here you go. You got 5,256 or you got 4,552. Those are the two places that if there was a correction of size, it could revert to the mean. Sounds silly up here, doesn't it? You don't think it sounded silly in 2021? Of course it did. And what did it do? It reverted to the mean, right? So again, we'll have to see what happens. But the higher this thing goes, it doesn't make it less overbought. And one of the reasons I specialize in strangles is because strangles involve calls and puts at the same time. And I think that having puts on some positions at some point would come in handy because if this thing does roll over, there's plenty of real estate underneath. Now, again, you have to stop making higher highs in order for this thing to roll over, right? So right now we just made a brand new high on the S&P of 5876. So the earliest you could stop making new highs would be November 30th. So keep an eye on November 30th. If we were way above 5876, then it would be December, the first possible month, right? Because you can't roll over if you keep making higher highs. That's pretty common sense, right? So keep an eye on that. Again, I don't want to step in front of a freight train. I also don't want to whistle in front of a graveyard or fall asleep at the wheel when we're at the highest price in the history of mankind, right? Okay, so that's basically as I see it. Again, right now, I've been saying in the short run, you've got resistance here, right in this neighborhood of 58, where are you here? Yeah, 58.33, which is where we are right this second. And then, of course, it's the new highs. So you have the all-time highs there of 58.50, and you've got 58.33. That's your neighborhood of resistance. If it gets through that neighborhood, obviously you're into uncharted territories. But I'm looking at an RSI here that was at what? Where is it at here? Well, over here, it was at 60, 65, right? And then over here, it's still at 63. And over here, it's at 56, 59. So I'm seeing a bit of a divergence. So I would be looking at the 1 month graph to see if there's any signal of a rollover. A little bit of one. Remember I told you here, 58.60 right up here and 58.80. This is your resistance zone. And right now it's right here. So these two things are meeting. And right now, look at the 58.26 number as very important numbers, 58.26, 58.28. If we were to break under there, then I think there could be some selling to be done. Because again, here you're at RSI of 76, and here you're at RSI of 66. That's a divergence. Then you had a pop up here to 54. That's not much strength. And then you had another pop up here to 53. That's not much strength. So if this baby starts getting under these numbers here, I would imagine that you're going to get a reasonable pullback. Clearly, the purple line would be in play. That's 57.90. And if it breaks there, who's to say gold's not going to come into play? So be careful up here because it's going to probably be very binary. It's probably going to either be a breakout to these new highs and 6,000, here we come, or everyone's positioned for that, and they're going to obviously, and it could be the buy the rumor, sell the fact. What do you mean buy the rumor, sell the fact? We're coming into the election. You don't think people are bidding up their stocks? First of all, somebody's bidding up liquidity. You got deficits going up 500 billion since September 26. You got the money supply growing at a positive number after being negative. Obviously, somebody's juicing up the liquidity. And obviously the prices are being juiced. But again, after the election, that's called sell the fact, possibly, because again, once people have the job, they're not going to be quite as gung-ho on giving away everything, possibly, right? So again, keep an eye on things. I think we're at pretty critical points, and only time will tell, but go with the flow always made sense, right? So if you start seeing 58.60, 56, 55, 58.60, 58.80, and it's on its way, don't fight the tape. Likewise, if it starts breaking under 58.20, 57.90, realize that it's time to get the raincoat out. All right, so that gives you a little idea of what I'm seeing on the stock market right now. Let's look at the chat room and see what we got. Okay, we got some stocks here. Let's talk turkey. All right, so we're going to start out with LAC, which we all know is the Lithium of America's company. And lithium is a battery deal, and a battery deal means, the electrification of power. And let's see, it says through December. Well, I'll look at it. First of all, I don't know how long it's been around. So I'll start with a 20-year graph, and I'll see that it hadn't been around that long. Go to the 5-year graph, and it hadn't been around that long. So I use a 1-month graph, a 1-year graph. And it tells me, obviously, you should have been buying the heck out of it at $3 because that's when it's against the line. Where do I like to do my buying? Against the line. What do I want to do up here? I want to go out for a steak dinner because I bought it against the line, right? So this is not the ideal time really to get into it unless it's parabolic. It is almost like an option because why? It's $4.50. So what's the most you could ever lose? $4.50. How would you lose it? They go out of business. So stuff like this, that's how I view it. I'm buying an option. It's cost $4.51. It's an option with no expiration date, right? And again, how would I lose the entire amount? They go belly up. So obviously, there's not a lot of a reason for thinking that's going to happen right now. So that's the way I would do it. I would buy it and I would put it away, and I would just say I really believe in this company if I do. And I don't know the company well, so I would do homework on what they do, see if there's a moat around it or anything like that. Let's look at the options. Again, this thing hadn't been around long enough to shave. Anyway, say you want to take a long-term option on it, because obviously it's probably a long-term play if you think it is a good play. So say you went out to next year and you go out till next May. You think it's going to have a nice 6-month run, 7-month run. Well, It's at $4.51. So you might as well just buy the company really, because 451 is not much. But if you wanted to play the option route, not you can get a $3 call. No, you can get a $2.50 call, which is $2 in the money, and you only have to pay 17 cents a premium, and you're in the money. So rather than paying 450, you're paying 217. You had an expiration date. Let's say you went for a little longer one. How about we go out till January of 26? This thing doesn't go up by then, probably not going up, huh? So here you go again. The 250 right here is at 250. So again, it's worth $2. So you're paying 50 cents for over a year, and that's half, about 80% of the price. And obviously, I'm not the only guy who came up with this idea, because you got open interest of 5,145, right? So that's the way I would probably do it. Put my $2.50 up, go out till January of next year. No, not January next year, January of the year after next. So that's a long-term option. And you got nothing, no coaster breaks. So if it goes up to, $15, you're in there for the whole ride. You're not doing a spread here. And so, you got $250. You don't want to go out to dinner. That would be a time to play, because that's about how much a dinner for two costs nowadays, right? Unless you're at McDonald's, and then you're going to get sick. So what are you going to do? All right. So anyway, there you go on lithium. Any further comment on that? Just put it in there, and I'll listen to you about that. Okay. So what do we got here now? Try to do them in order, in fairness. Okay. ACIW. That's the beauty of doing these things. I don't follow every company, and so I learn stuff too. So what do you got here? Let's see. ACI Worldwide. Not sure what they do for work, but I'll tell you what it looks like technically. Let's get back to the screen. ACIW. Yeah, and when you put up your symbol, if you want to put what type of sector it's in, is it an energy stock? Is it a tech stock? Whatever. Be helpful. Okay. Because I do follow the sectors. This thing's not happening for me yet, so go back to the chart. This should be it. There we go. Okay. ACIW. Okay, $49. Let's start out with the big screen. The big screen's the 20-year graph. What's it look like on a 20-year? It looks like it's very overbought. Obviously, it has good news, but again, I like to buy at 26, maybe when it crossed blue at 28, maybe when it pulled back here to 34, 33. But this is not my cup of tea. This is called the land of milk and honey, and I don't want to start buying when it's already in the land of milk and honey, right? Or this is where you plant your seeds, and this is harvest time. So it's hard to start planting in October when it's harvest time, right? Okay, so let's go over here and let's look at the shorter term graphs. Okay, let's look at the RSI here. So you're at 83. Where are you? You're at 78. I saw an 83. 78. Then up here, you're at 74. And then on top of a mountain here, you're at 71. That is a declining RSI. What does that tell me? It's running out of steam up here. So that's why it pulled back, and it's pulled back to the red line. Where could it pull back further to? How about the green line or the blue line, which would be 44 or 41? So there's your risk, right? Risk of pulling back. RSI is still in a positive mode, right? But you can see all of this action here was done on weaker volume, which really opens the door for the bigger pullback. Now, if it gets back above what? 49.85, which it is right now, it could get right back on the bicycle. I don't know the company. They may have something that's the catch meow that people will pay anything for. Maybe they have a GPU. I don't know what they got, but whatever they got, people have been paying up for big time since January. And again, it's had some small pullbacks, never really broke the red line until now. Red line's still pointing up. So again, I'm not going to badmouth this thing at all. Let's go to the 1 month, the 1 year. Now here we got a little bit more evidence, right? Because you got the 74 over here, and over here, where was it over here? 76, right? Then you got 74, then you got 67, then you got 66. Again, it's an engine running out of steam. And the trend turned down at 51.55. So that was your sell signal. Now there's a traffic jam. Traffic jam comes in between what? 49.89. Well, actually, it comes in all around $50. Because you see all the averages there in the box, all around $50. So the longer it stays under $50, it's vulnerable to keep going down. I would think if it breaks 49 and 48, get a good shot of going down to that number I talked about, 44. So that's it. And it is underneath the 50 and it rallied back to 50. So if this thing starts giving it up, you can probably plan on 44. And even we said 42 or 41. So I think the numbers were, if it pulls back of any significance, you got a 44 to 41 number. And now you also got a 36, 37 number. What did it tell you on the 1 month? Told you to get out of this thing at 53. Why would you have done that? Well, because you see here, the RSI is at 65, and over here it is 59. That's a divergence. The red line turned down, and you say adios. And now you can come back in because you see it hit the gold line at 48.50, 48.75, and the red line's now turned up. Okay, but it's still mixed. But it definitely looks like it could go right back on the bicycle. So if this thing went up to $55 or something, it wouldn't surprise me. Got a gap over here, just about 51.50. So on a short-term basis, the selling looks like it had dried up and it's turning up. Okay, so this one's pretty simple to me. If you start seeing prints, above 50 and 51, it's probably going to go and take out the highs. If you start seeing prints under 49 and 48, it's probably going to go into a more significant correction. So this would be a don't fight the tape kind of deal. And also, if I'm looking at calls and puts, this one would be one where I'd look at the strangle. Why is that? Because it's on the verge of doing something sharp up or down. And rather than guessing which side, you buy both sides as long as the premiums are reasonable. That's the key. Are the premiums reasonable? And when do they have earnings coming out? Let's see if I can do that here real quick. Oh, never mind. Anyway, I would look to find out when earnings are coming out because, that might move the needle quite a bit. And if earnings haven't come out yet and this is bid up, it could be buy the rumor, sell the fact. You don't know. But anyway, this thing does have a nice uptrend going, no doubt. It definitely has been weakening on the rally. Not good. It definitely has lost some altitude, but on the monthly, it does look like it's recovering. So again, let the market dictate the activity by either breaking above 51.52 and getting going, because right now the RSI is at 49, so it's right on the ledge. You start seeing 51.52, RSI jumps to 55 to 57. Maybe it's going to go to that acceleration phase if that RSI can get into the 60s and then into the 70s. But with the weakening of all this stuff, again, there is some real estate to fill in on the downside. So this is going to be pretty binary up here. And again, you can do a hedging too, if you own the stock, you could buy a married put and then give up a little bit of upside by buying the married put. The married put means you're married to the stock position. You're long the stock. You buy a put as insurance. I mean, come on. You got your car insurance, you got your health insurance, you got your house insurance. You're not going to insure your stock every once in a while. So that's what I'd be looking at doing, because I wouldn't want to wake up and finding at 38 because whatever they do just got out of favor, or whatever they do is not going to be in demand like they thought, because anything that goes straight up also has the ability to pull back sharply too. Because again, just imagine if all these people have been buying, right, wanted to get out at the same day. Well, that means the market makers of Citadel, Goldman Sachs, and those kind of guys, they're going to be the only one on the other side of the trade if everybody wants out. And that's why you'll see 44 or 30, 41 or 36 quick, because if all these people want out the same day, who's going to stand in front of all that volume? Nobody. So that's how they come. An order imbalance can show you. And I'll show you just to give you an idea of that example. When you get an order imbalance, you're going to get a major move, but that major move won't last, because it can't sustain itself unless the volume keeps going. So here we had Tesla going from 270 down to 210, hitting all my support down here. Now, if they have a good earnings report, and I don't know how good it was, their revenue was down quarter over quarter, but their earnings were up, and they had glowing comments from Musk about everyone's going to have the robo-taxi in their parking lot or something. At any rate, this kind of a spike up smells of short covering and spec buying. And of course, if no one is selling except the market maker, they're going to put the stock at 270 and say, okay, now you're filled. And then as you can see, it's not going to stay at 270. It's going to come right back down a little bit. So this is called a spike up and order imbalance. And order imbalances don't last forever because once they are filled, you have to find new buyers at 275. And obviously right this second, that's hard to come by. So that's exactly why if you're buying calls down here, which is what you should have been doing, because that's a support zone. And the calls must have been reasonably cheap. If you get that kind of a spike, you want to grab that money and run. I'll give you another example here. This is called China. And this has Alibaba in it and a bunch of other stuff. This is called FXI. Another example of when they spike up, you got to grab the money. Okay, this is called, well, I'll give you a better example. How many people were short China since they've been going down since 2021? How many people had short hedges on? How about the whole planet? So when they announce, first of all, they give you a good reason that, before they didn't announce this thing till here. That's why I was telling people this is great value down here. David Tepper's got big positions. So does Michael Burry. And the trend has changed. So let's take our shot. Some of these options were going for $1 or $2 or something like that. Right at the money, 26 for $2 and 6 months out. Come on. So obviously you spike up like this, that's an order imbalance. And an order imbalance doesn't last forever. So obviously you go up towards 36, 38, and you got calls down here. You're going to dump those because again, this is an order imbalance. Once everybody got filled, right, it comes back down. Now, if you come back down here and you get a Fibonacci pullback of 61%, you might want to reinstate your positions. But that's just an example of how to trade them a little bit if you're not familiar. Okay, what do we got here? Spike up today at earnings. Oh, Paul. Trying to see what Paul's talking about. Well, anyway.